Well, welcome everyone to today's webinar titled Thriving as a Treasurer Amid Economic Volatility. This is Brian from Strategic Treasurer, and we're pleased you could join us as we discuss practical insights and strategies to help Treasury professionals navigate through turbulent times. Our speakers for today are Leo Gill, Vice President of Product at Bottomline, and Craig Jeffery, Founder and Managing Partner of Strategic Treasurer. Welcome, Leo and Craig, and I'll now turn the presentation over to you.
Right.
Thanks so much, Brian. Leo, it's good to present with you again. I know we've done podcasts, or at least one podcast, and at least one webinar, so it's good to talk with you again.
Yeah, for sure. Great to be here, Craig. It's always, when we see a topic on economic uncertainty, it's always, very popular, and you can see by the number of participants we have here today. That's great.
Excellent. Everybody, thank you for joining, whether it's your evening, early morning, midday. Thank you for spending some time with us. We have a fair amount to cover at a reasonable pace, not a rush pace, but a smartly moving pace. Let's get into what we're going to cover today. So our topics for discussion, we have 6 panels laid out here. These are the elements of our agenda. The current situation, what we'll be doing here is talking about some of the uncertainty and stressors that you're experiencing. Your company may experience them in greater or lesser levels. So issues about labor market, inflation, war, trade, tariffs, everything that can come up that can create a stressful situation is background for the broader discussion. And then we move on to the treasurer's role. What is the scope? What are the responsibilities? How is that changing? How's that changing gradually over time? While at its core, it's protection of the country's most liquid assets, providing liquidity. So optimizing the organization's cash, liquidity, and risk, providing a steady hand. Those are some of the things that we're going to be highlighting as we cover that area, also as background. And then on liquidity and risk, the subtitle there is Ensuring Cash Resilience. An organization that is resilient can bounce back, has margin to handle and adapt. And how do you get that margin? Either you stockpile a bunch of cash, or you provide that type of protection while having better monitoring to see where you are. The ability to see farther down the road matters. And so visibility and control matter, which is the next area as well. In the idea of cash is king, and knowing where your cash is, knowing where your king is, those things matter. So we'll look at visibility and control. And so the importance of it and some of the essential components of achieving good visibility for cash positioning, for forecasting. We're looking at various scenarios that can occur in an organization. So those are some of the key things for us to cover during the 4th rectangle. The 5th rectangle, Treasury technology. We both love technology a lot. Leo and Greg, we both love technology. And so, what are the benefits that you seek in an organization to help fulfill and address the challenges of your organization? And technology is almost always part of the answer in so many ways. So we'll look at technology, where it can help. We'll focus in on a few areas. And then towards the end of the hour, we'll wrap up with 4 key takeaways. We'll look at a couple concepts: the playbook, stress test, the use of tech, and the strategic role that Treasury plays. So that is our list. That's what our journey is going to look like. And let's get started on it. So today's landscape, volatility is the norm now. I think we'd say, unless you live in a couple countries where there's war or some extreme disruption, I think you'd say that it's a relatively volatile time period. It's certainly not the most volatile that many of us experience in our lifetimes, but it's certainly not a particularly calm period. So what's going on? What are some of the drivers of volatility? Well, there's central bank actions. They're adjusting the rates they're charging to adapt and account for inflation, employment numbers in the U.S. That's the charge for the U.S. Fed. But most central banks are making adjustments to try to adapt and provide some stability in that environment. And inflation, goes up and down when there's trade conflict. That can make a pretty significant difference. Disruption in oil, that tends to affect much of the economy. So all of those fit into this world of a volatile economy, more or less. And it's not that the volatility stays at the same level. It expands and contracts. It can do that from a headline. It can do that from an explosion. It can do that from the start of a war. There's many areas where that can the disruption and the volatility can arise from it. It can subside as well. So this is the landscape. Most of us are, I'm sure, are quite familiar with this. And so what are the implications for treasury operations to account for an environment of volatility? Is we think of forecasting. How do we know what's going on? We look at liquidity. How do we manage the assets that we have? How can we ensure we have more liquidity, whether it's borrowing, looking at our cash conversion cycle? And then finally, the risk element of exposure. Where are we exposed? How can we take on the right level of exposure or reduce that exposure to stay within the levels that we have? This all fits into that concept of how do we thrive as a treasurer amidst economic volatility. So I've done a long preamble. Now we get to the star of the show. It's Leo. Leo, we talked about some of the volatility. What are some of the specific pressures that we see on Treasury?
Yeah, thank you, Craig, and thank you for calling me the start of the show. So, what we see today is, I guess every time you and I speak, right, there's always this evolution of Treasury where Treasury is getting pushed to become more and more strategic in their organizations. And, there's this move from being, static and policy driven to being a lot more dynamic, right? So think about the first point on, FX and interest rates, right? What we've seen a lot is treasurers have been very much focused on just checking the box of they are following their hedging policies mandated by their boards, and they produce a report that then gets filed and audited later. Where now boards are being a lot more open to changes into those policies, where the Treasury team now has a lot more ability to be more dynamic, right? Where you are, instead of just obeying your hedging, your policies and looking at your exposures, you now can start leveraging different FX instruments to better manage the changes in the market conditions. Second one being liquidity risk and volatile credit markets. Credit is really tightening across the board. We've seen even large, well-run businesses who are getting a lot more scrutiny. Borrowing costs keep increasing. So that reduces a lot of the flexibility that the Treasury team may have to cover any shortfalls. And that's where it puts a lot more pressure on being able to do, as you said, better forecasting, better scenario planning, where you start looking at, what happens if my credit line shrinks with a particular supplier that is part of my supply chain, and how do I best fulfill that gap? The third, of course, and it's a persistent point, is on complexity and cash visibility, right? Lots of organizations still rely on fragmented systems, lots of different banking portals, spreadsheets, disconnected internal systems and ERPs. And that slows down being able to get a good cash positioning, provide an accurate forecast, and ultimately, speed up decision making, which is what is needed. And that's the pressure that the Treasury teams have nowadays. No one asks how you got the information; they just want to know the answer, right? And finally, it's a constant theme is always fraud and risk management, right? So it's not that fraud is becoming more. It's not that fraud is growing rapidly or slowing down rapidly. It's just it's more sophisticated. Now you have AI is being used to mimic executives, spoof invoices and hijack payment flow. So all of that comes back into Treasury being the part of that line of defense, with having strong controls, understanding anomalies within flows within the organization to enforce their policies. So, to tie all of this together, I think it's the pressures really going from a more static, policy-driven organization to a much, much more dynamic, integrated organization within the office of the CFO.
Yeah, thanks. And I suspect quite a few of you can identify other pressures that Treasury faces, including, respond more quickly, run more models, all of these challenges that, we see year after year, the expectations have increased significantly. This brings us to poll question number one, and you'll be delighted to know that it's a multiple choice question. You can answer more than one option, except you shouldn't answer an option and other or ensure. So any of the first five, 1 through 5, you can select, and then other ensure if you don't know. But what are your top Treasury priorities for the next 12 months? If we're talking about thriving as a treasurer amidst economic uncertainty, what are your priorities? How does that fit into this for the discussion? We have a presentation, but we do try to adapt. If we see notable trends in particular areas, we'll give a little more love to that particular area. So select all that apply and hit submit. If you can't see it, look at the chat box. Brian has pasted some information in that shows how to find the poll or the quiz. We'll leave that up for a little bit more time. So go ahead and submit that. If you have submitted that, please look over at the chat box. And if you're not following Bottomline or Strategic Treasurer, click on the link and follow our companies on LinkedIn. That is awesome if you can do that. I know it's extra work to click twice to do that, but it makes our team really, really happy if you do that. If you like data, if you'd like to see the results of all the polls and quizzes embedded in the presentation document after, type the word bottom line in the chat box. We'll just say if we have 100 people type bottom line, we'll send that out to everybody. So that would be awesome. And I know some people like to type it into the Q&A box, and that counts too, but Brian just has to go find and count those. And it's nice to keep him working hard on that. All right, Leo, I'm going to ask you to make some comments on this. I'll do a quick overview. Number one, improving cash forecasting accuracy. That's like always the top. 62%. Number two is enhancing liquidity management. And then we have 3 of them that are within just a few votes of each other. They're at 33 and 34%. Fraud, upgrading tech, reducing financial risk exposure. Does this say that there's a lot of key priorities across every area we just mentioned, or is there some other story out of this?
Yeah, no, I think you're absolutely right. If I had, $5 for every time cash forecasting was number one in a poll, I think I would be doing really well. It's a constant theme of the challenge. It's quite challenging, right? A lot of companies, you have a lot of data in disparate systems. It's very hard to consolidate the data in one place. Also, finding a way that you can build the flexibility in your cash forecast based on how your company operates, right? It's not just about looking at account balances and predicting it or forecasting on account balances. Your companies, lots of companies will have lots of other financial instruments and other ways to get at cash to tell a story, right? How you organize internally with your GL accounts and how it flows into how your company operates. It's quite challenging because there is a great number of variability across companies in their operations.
Yeah, and seeing all of the categories reaching at least a third is pretty impressive. And none of them are 2/3 or more, so it's in a fairly tight band.
Right.
But certainly a lot of things that are consistent. So yeah, thanks for your comments, Leo. Thanks everybody for answering the first poll question. We have more to share and more to learn. So we did say that we would talk about Treasury's evolving role, how that's changed with expectations. I'll start us off, and Leo will weigh in more on this. Anytime you see someone who's drawn a chart or someone who's drawn a project plan, you know what they do, because if it's a project plan, their section is detailed out very fully. Everybody else's section is like make the car, and then your section is detailed out. Even if you're making a seat, it's all the detailed component parts are there. And so too, you can tell that this chart was made by people who think treasury are at the center. Well, our focus is treasury, the core, the heartbeat of the flow of cash. There are so many areas that relate to the flow of cash and treasury's responsibility to provide for liquidity through debt or to invest extra cash and to put it into the cash conversion cycle through effective working capital management matters. So that's why we drew that at the center. So if you're not in treasury, don't be offended. If you are in treasury, that's why we put it there, and don't brag about it. But just as you look at it, what is the role and what are some of the increased expectations on treasury? If you consider working capital, the expectation is always to be more efficient with it, to optimize the use of working capital instead of just pulling working capital out so you tighten credit to the point that sales can't happen. That is ineffective. You want to have that right balance of providing enough capital for sales to be efficient without selling to people they should not be selling to. And those are some of the areas of managing working capital with the overall operation of the organization. The other factor is, payment terms for when you buy, payment terms for when you extend credit to different people in the organization. You want to make sure that those things are set so that it supports what you're trying to accomplish. In other words, have adequate liquidity at the right time. But not everybody pays at the same time. Your organizations probably don't pay at exactly the right time. And so there's aspects of this role of how do we know when we're going to get paid? How do we make it so that we can be effective in our decision-making process around forecasts, either on the short term or on the longer term as our business mix may shift. So things like forecasting collections, payment terms, so we know when we have to make payments, we're staying at or very close to the payment terms, and those things are aligned. Those are some of the core liquidity and working capital requirements. There are other elements of, on the executive side, making sure that there's strategic insights. What businesses are we in? What do we need to avoid? What are the rational and business reasons for that? Treasury needs to weigh in, and Treasury is expected to weigh in there. And there's much more on the risk side. So the overall operations, we didn't write risk on any of the individual components, but risk matters. Operational risk or payment fraud, operational risk in other areas, financial risk, exposure to foreign exchange, to commodity price, to disruption in our supply chain. All those factor in. And I'll just say one more thing here, and I'll promise I'll turn it over to you, Leo. When we consider some of the risks that we take on, it's how do we optimize those and balance the risk and return. Too little risk means you leave way too much opportunity. The organization, too much means you imperil the organization. So this balanced perspective matters significantly, and that usually requires models and understanding mathematics and knowing that you don't know what's going to happen with tariffs, interest rates, inflation, trading partners. And so all of those have to factor in, that we don't assume the exact median of the risk probabilities. Like if we roll 2 die, we expect a 7, but it can range from 2 to a 12. So we have to assume we understand some aspect of that risk, and that we can get a 12 or an 11 if that's good, or we can get a 2 or a 3 if that's bad. And knowing that that's the case, the Treasury has to be as mindful as possible with the forecast, with identifying the risk, and making sure that the risk stay within the risk appetite that the organization has. Well, that gets us started. And Leo, I think I left a few things for you there, maybe.
Yeah, no, for sure. No, I agree with everything you say. it's interesting how treasury very often they're either involved too early in the process, like, in a capital allocation, part of the cash conversion cycle, and then at the end, right, just from a compliance standpoint. So, what really goes back to that idea that I know you and I have spoke about this before, where ideally, treasury needs to be a superintendent of payments in the organization, right? So, like this chart shows, more quarterbacking the connectivity between all of the other functions in the office of the CFO. So, the treasury doesn't have to be a control tower, right, involved in every payment approval or every invoice, or every transaction in the organization, but just needs to be able to guide the decisions that will ultimately affect cash flow. Like, for example, if your organization is pushing for optimizing DSO, that needs to be aligned with your collection policies need to be aligned with your forecasts and your liquidity needs. Otherwise, you're just solving for accelerated collections, more cash in the door, but potentially there are other avenues and other coverages you may need that will work better. At the same time, on the flip side, think about if you have an accounts payable team that it's stretching DPO, that's great. You can now have more cash on hand, but that could be sacrificing a supplier relationship where that supplier is also going through financial trouble and it's tightening credit for your organization. So if the treasurer is not connected with how DPOs be managed within the AP organization, you could ultimately be in much worse situation than not. So all of that, comes back to, I think this chart is really critical, is where treasury is playing this quarterback position within the organization. And these decisions, they have massive working capital results, right? It's all about managing to profitability, being able to know that the company is going to be doing well as the changes in market are happening so quickly. So again, like it's all about the strategic evolution for treasurers, all about moving from just reporting on cash positions, providing capital to the capital allocation across the organization, to a more dynamic central role, playing that connectivity and quarterbacking the decisions that are happening inside the finance organization.
Yeah, and so as we shift off of the role to the broader concept, the balancing risk and return, I think everyone in treasury and most people in finance understand some aspects of risk and reward. The trade-off. And maybe you're used to the efficient frontier. Certainly on the personal side, people talk about the mix of stocks and bonds. Equity is more volatile but provides a higher return over time, and bonds are more stable. So you're used to those in your broader financial life, but certainly, that's just a stylized picture, showing, the efficient frontier. If I can get above this, it's awesome. If I'm below this, it's okay, but depends on how far below it makes sense. And so balancing risk and return matters generally, but it certainly matters during volatile times. And some of the examples are, we talked about DSO. Leo was mentioning, DSO. If you're trying to tighten DSO, days sales outstanding, if you want to pull that back in, it provides you with more liquidity. And so liquidity may be the number one driver. So you're willing to give up on some sales by pulling it in. Conversely, you want to make sure that there might be good underwriting. So maybe you're pulling in on those that are a little bit more risky. Maybe you're extending it to take market share. But there is a risk and return trade-off. And so we think about that from a risk standpoint, but we can think about that from an operational standpoint as well, and from some other views. And I'll give an example. We're going to talk about visibility, and I want you to think about that from a risk and return standpoint. So let's talk about something that some will consider interesting and others boring: reconciliation. If you said to an accounting group, the group that was in charge of reconciliation, let's do a cost benefit analysis of which accounts we need to do reconciliation on. What will your accountant person say? I mean, after yelling, like, and saying, I'm so surprised, I don't think anybody could be that dumb, or whatever they would say in a professional setting, they would say, this is something that we need to do. It's not a choice. It's how we provide assurance that our financial statements accurately reflect what went on. And so we need to do reconciliation. And they would be right. Now, how you do reconciliation would be based upon how efficient you do it, how often you need to do it. And that's a factor of how much is at risk or exposure. So some reconciliations can be done at the end of the month. Some can be done every week. Some need to be done daily. Some need to be done in trading situations, moment by moment, extremely quickly. And so there are trade-offs there. So that's talking about reconciliation. I'll jump to another area that's not necessarily what we think about risk and return, but visibility and forecasting. What's the risk and return of having a good forecast or a poor forecast, or of not having complete visibility? And so thank you for allowing me to riff on this a little bit, but if you say we have visibility to most of our cash flows, 94% of our cash flows, 95% of our cash flows, and that's made up of 65% of our accounts. We have a number of banks that aren't there, but they're not that important. I would say that you are taking on a certain level of risk. You'd say you should have visibility to all of your accounts across the globe and have them reported on a daily basis if they're used for operating purposes. And what if someone says to you, what's the cost benefit analysis do for doing that? Should we do a cost benefit analysis to see if it makes sense to get visibility to those accounts? And what would you say to that? And what would you say? Would you say, oh yeah, we need to do that? Or you say, this is unreasonable. The standard of good corporate conduct is that any of our operating accounts, we have visibility to on a daily basis. How we get that visibility is where the cost benefit analysis comes in. We want to do that effectively and efficiently. We want to get a good price from our banks, but we need to see where cash is flowing in and out. What's the risk? We miss a fraud. Something reputational goes on. We don't have information to make proper cash decisions. We overdraw accounts that we don't know about and damage relationships. There's a significant level of risk that can exist. So as we talk about balancing risk and return, that is the treasurer's domain. What businesses you go in? How do you have visibility to accounts? What's our exposure to certain currencies? There's a lot that we could talk about there, a lot more than I already talked about. But I just want everyone to think about this idea of risk and return. We're very used to diversification, and that's a safety measure. But things like visibility and tools that help us monitor and see what goes on are just as important as diversification in some ways. In some ways, it's more important. In other ways, diversification can be more important. But I just want all of us to be thinking about how we solve for our organization's need on the treasury front. Now, Leo, I know this was my slide. I was just going to move on to the next one, but I talked a lot. I don't know if you have any comments before we move to the next poll.
Yeah, no, you're spot on, right? Is balancing risk with expected return. We see a lot of organizations, with this, as you said about some organizations don't have a full picture of cash because they may believe that it's too expensive to have a real-time view of my cash positions because of either fees that I have to pay to the bank, or I don't have a system. I'm using spreadsheets and budgets are tight right now, but it's all about managing that, that risk with the expected return of a potential investment, or working a little bit more to get better real-time visibility into cash. What's your ultimate reward to that? And for different companies and organizations, it's going to be different results, but it's just having a clear view, exactly how you're showing here, having a clear view of those risks and returns of them are really critical.
Thank you. All right, that brings us to poll question number 2. It's on the screen. Another multiple choice. This is a great day for great polls. Which area of treasury technology are you most interested in enhancing? Cash forecasting tools, payment automation, all the way down to not planning any changes, other, or ensure. Go ahead and select all that apply. Hit submit, and we will look at that in just a moment. So once you've selected them all that you're going to submit, hit submit. And then I am told by Brian, who's added things up, that we need 24 more bottom lines in the chat box in order to be able to send these out to everybody. I like how some people type it in a couple times. That's awesome. We love it. And yeah, it's also a good way to remember this Bottomline, Leo's with Bottomline Technologies. So they have liquidity visibility tools, treasury aggregators, and Swift service bureaus, and lots of other great tools like PayModeX, etc. If you weren't familiar with them, which most of you probably are. Awesome. So Leo, we have the answers. Number 1 is cash forecasting tools, which I know exactly what you're going to say on that. Number the least is not planning other changes. The least is APAR automation. So any thoughts, any comments on this?
Interesting. Yeah, interesting enough, the second one is AI and predictive analytics. So quite interesting how the evolution of all of these tools we see today. Treasury is, Treasury typically, as we all know, has been a little bit of a slow adopter, into new technologies, and AI is becoming more and more in the forefront of people's minds nowadays.
Excellent. Excellent. Yeah, we see a lot of interest. We just completed an AI survey. We're doing an AI workshop. If you're interested in being part of the AI workshop, it's about a 3-hour workshop coming up in a couple months. Feel free to type in AI workshop in the chat. I'm going to go ahead and close this poll question down. We have enough responses for for that poll, so we'll send those out with the deck to everybody. Thank you for participating and doing that. And that brings us to liquidity management, Leo, and I know you have a lot of great comments on this.
Yeah, no, thank you, Craig. So, it's really thinking back of, we start with revisiting your liquidity fundamentals. It always goes back to, before you're chasing optimization, let's go back to the basics, right? Do you have really a clear 100% cash positions or visibility to your cash positions? How close to real time is that? How are your forecasts integrated to your cash positions, and are they dynamic enough? Can you run multiple scenarios? Can you do more scenario planning around your forecasts versus looking at a static forecast to just get updated once a day or once a week, right? That's really the first step. And even I know you touch a lot on forecasts, and that's an area that we have been, Bottomline has been working and investing quite a lot. I can't tell you how many treasury organizations that we talk to that still are forecasting either on spreadsheets or they're forecasting on invoice due dates, right? That's such a miss, right? From an ability to have a more accurate forecast if you are just looking at due dates of invoices. But it's understandable because as you think about companies with hundreds, thousands of customers, it's really difficult to understand patterns and customer behavior, right? And that's where I think our second point on the survey, the second result, AI plays a really interesting and critical role here, where you can analyze a lot more data quickly and present that to the treasury team. The second point of strengthening your financial position, it's really more about being dynamic, right? Before, it was always about just keeping track of what my buffers are, and so long I had my exposures well managed, and I could produce a report. I check a box, and my company's doing well. Where now it's quite different, right? Is you got to be looking at a whole different sets of of ways around your company's organization, which of course ties to your risk appetite. Are you getting different funding sources? What your banking contracts say? You have commercial paper. What's your pulling strategy is in your organization. So basically, a whole rethink of your capital allocation in your organization is really critical. And last is where you get into really deploying cash more effectively, right? So, having liquidity is one thing, but using it wisely is completely another. So just having that, agility into getting insights from the information and data you have in more real time, then you can start accelerating your decision-making process. And then you can look at, as we talked about payments, right? Treasury can start looking more into the payment flow in your organizations, inflows, outflows. Can you delay? What payments can you delay? What payments should you help your accounts receivable team accelerate, and so on. So that's why we see a lot of companies gaining a lot of ground, is just using more real-time data through their banks, or through vendors like us, the Bottomline, leveraging more AI capabilities within their cash forecasts. It's what helps them really get to the next level.
Yeah, that was great, Leo. I think everyone's familiar with the people, processes, technology. We think of structures and then maybe data as well. But on the structure side, Leo talked about optimizing cash concentration and use. And the other thing that we don't talk about as much on this slide is technology. But if your structure is bad, you can employ a lot of technology and it's still hard to get a good forecast or cash position. Have the ability to manage things nimbly and practically. And then the technology side, every one of these things has some technology piece that can enhance what you're doing. And that need changes over time as you grow in complexity, as you acquire, or as your business mix shifts. Those things all need to be factored in. So thanks for your comments on that, Leo. And then on FX and interest rate exposure, we'll do a tag team on this. I'll start and hand it back to Leo as well. We have three headers here: hedging policies and when to review them, monitoring macro indicators, and strategic risk mitigation. Not everybody has FX exposures or interest rate exposures. You have some exposures, and so the concept is helpful. It's consistent, even though there's differences if it's commodity, interest rate risk, counterparty risk. All of those factor into what policies you have for these different types of exposures. What framework do those policies flow out of? The framework being, what level of risk can you absorb? What level of risk are you willing to take on? What do you need to avoid? What do you need to manage with some type of hedge, a financial instrument, or a different method of reducing those exposures? So that idea of how does that fit into what your organization has and needs to do? And then how do you regularly review that? Not just to make sure that the wording is accurate, but that it fits with your framework. What level of risk is the organization willing to take on? Not just what it's able to take on, the risk capacity, but the actual appetite that it's willing to suffer a loss by spending less on risk management. And at what point do you have to say, we need to move and remove and reduce these exposures and bring those in line with our risk appetite, what we're willing to bear. I'll say a few things on monitoring macro indicators. We can go back and forth if I covered your section, Leo, but monitoring macro indicators, what's going on broadly in the industry? We can hear the news. I always think weather people in the news system, everything's dramatic. We got a blue dog, moon coming up, which will weigh whatever. And some of it's meant to get us all excited about watching the news about the moon or the weather or whatever's going on. And sometimes we hear that in some aspects about economic environments, but mostly the news that we hear in the financial realm is fairly straightforward. but monitoring what's going on with central bank activity, inflation rates, um, certain commodities like oil in particular, maybe other commodities that impact your particular industry. Monitoring those indicators, staying abreast of what's changing, how that may shift over the next couple of years, puts us in a good place to monitor the risk, being a little bit ahead of the curve as you're thinking, as you might model what other changes or potential changes will do to your cash flow, to your profitability, and to the stress that your organization can bear. Feel free to jump in, Leo. Anything you want to comment
Yeah.
on?
No, that's exactly right. Like as you're saying about the changes, what it comes to my mind is all about agility, right? Is how fast can you react to changes? What we've seen in the past few years, there has been this change, especially as all of the volatility has gotten to exponential levels. Is a lot of treasurers, when they would talk to us, it was always about, how can I see my hedging policies? Can you generate a report that will show me that I'm doing a good job, right? And ultimately, that's what it comes down to. And now you see even boards and large companies are exchanging their hedging policies to like 2 to 5 years, so a much longer period, which what's happening is that now it's flipping into being more dynamic, helping the treasurer starts making more decisions about leveraging more FX options versus just following their mandates with the current four contracts they have. So all of those changes are making it less of a policy driven organization into a much more dynamic. As you said, you're monitoring all these different macroeconomic indicators to try to forecast where the market is going, where a company's going, and ultimately, which is the last point here, right, is to do a more strategic risk mitigation. And all of that always ties back to, being able to model different scenarios, being able to have a more accurate forecast that tie in both your cash, but also your FX positions, your loans, your other financial instruments all together, so you can have a complete view of your organization's health at any point.
Nice. So our final poll slide. Biggest forecasting challenge. You get to pick one only. What is your biggest challenge in forecasting cash? Inaccurate, incomplete data, limited input or collaboration from other departments or with other departments, inability to do what if planning or scenario, limited cash visibility, all the above, not a major challenge now, unsure. Those are your options. Go ahead and enter those, and we are in great shape. I'm going to ask for one more thing in the chat box. If you'd like, how many interest rate changes do you think the US Fed will make before the end of the year? Now, here's how you would put them in there. You could do, if you think there's going to be 2 increases, do +2. If you think there's going to be 1 decrease, you do -1. If you think there's going to be an increase and a decrease, or a decrease then an increase, do -1 +1. And so, we'll just put that in there. Be interesting to see. We can add them up later. I'm not going to try to bully Brian to add up and see what things. That's right. Put a 0 if you don't think there's any changes before the end of the year. This is good. You figure everything out. That's what I love about finance people. There's 2 kinds of people in the world: those that can extrapolate a conclusion from incomplete data, and all right. So what is your biggest challenge in forecasting cash? Leo, this is your space, your domain. Let's just select one. It was all of the above. So that's like, hey, life is tough. And then inaccurate, incomplete data, number 2, and then limited input, which is sort of like data as well from other departments. Any thoughts on this?
Yeah, data is critical, right? And being able to combine data in one place leveraging your systems and extracting data, combining all of that. It's a challenge. It's in some ways it's a challenge that we at Bottomline have been taking for many years. And we like to sometimes use the phrase, it's the life we've chosen. From working with data and integration, it's quite a challenge for many organizations. So definitely data. The limited cash visibility, as it's an interesting one. I think will be a nice segue into our next slide, is where I see a lot of organizations. I talked to a lot of organizations what they think they've solved their cash visibility issues, but when you start digging a little deeper, you realize, and they realize that they really haven't fully either. So yeah, quite interesting set of results here from the poll.
Thank you. And everybody, thank you for your comments. Lori has a good question. Will we give you the net result? Yes, we'll send that out with the material. Either Brian will add it up or I'll get someone to help add that up and show the net result. We have a nice curve on that. Yeah, so thanks for voting that. I find that particularly interesting based on the energy in the chat box. I think a significant minority are interested in as well. So on the cash visibility and control, Leo, I know you're going to do the yeoman's work on this slide.
Yeah, for sure. Yeah, as I mentioned before, in a lot of organizations, they'll say, and as we got a little bit from the poll, where cash visibility is not an issue for us, but you start asking, well, but how recent, or how is it real time, or are you just looking at prior day data that you got from your bank? Do you have access to 100% visibility across all of your cash in the organization? And sometimes, a lot of times, the answer is not necessarily. So that's where I think a lot of companies fall a little bit, because it just doesn't it's not just about thinking that you have access to all information or enough information. It's really truly about, can you aggregate all of your banking data in one place and having true complete cash visibility. And when I talk about cash, right, it's not just about cash, right? It's also about all of the other financial instruments you have, and are they really in a centralized location where you can see all of that information together? And typically the answer is no, right? When you start digging a little deeper. Then, fraud prevention as a follow-up, right, to that, where of course fraud is still, all of this visibility, the ability to optimize cash without any controls is really dangerous. So you need to have the right guardrails in your organization. And as AI keeps also coming up, one of the really smarter approaches nowadays is to leverage more AI for anomaly detection. That's an area that we are working quite a lot right now at Bottomline on enhancing our cash forecasting solutions into being more AI driven, where we can detect payment anomalies, we can detect different situations that, just looking at thousands and thousands of payments, being able to provide customers with better fraud prevention, on top of course, sanction screening and everything else. And the last part, is we always talk about APIs and what role do APIs fit in. I think APIs, think about it as more of a connectivity means to get data quickly in your organization, right? It's not a one size fits all. You're definitely not going to use APIs for pulling a very large MT940 or BAI from your bank, right? So a lot of times, because of the volumes of data, APIs may fall apart a little bit. But when you think about access to more real-time data, being able to get access to more real-time data from your ERPs, from your treasury systems, from your banks, that's where I think APIs can be a really nice connectivity mechanism across the organization. All right, and next, so now we dive a little bit into the solutions. And Craig, now we're going to do the opposite. I'll start, and I'll ask you to jump in here. So first one, of course, your cash management solutions is, that's really your treasury management system. That's your control tower, right? So that's where you want to be able to combine all of your information in one place and get rid of spreadsheets, either for cash positioning or for cash forecasting. You want to treat your cash management as your source of truth for cash. Then the next point around payments hubs and platforms, it's really critical where we talked about Treasury becoming more the superintendent of payments. Treasury needs to be involved in understanding the payment flows in your organization. So, and lots of organizations have, very complex approval workflows, or how you disperse cash, how can you make payments, who can approve, and being able to automate all that and leverage more of the platforms. There's a nice connectivity between cash management and payments, right? They almost go hand in hand together in a lot of ways. Then accounts payable automation, of course, like very, paper heavy processes, that there's a lot of them. AP automation definitely reduces a lot of these touch points. When you think about AP automation, it's also interesting to think a little bit beyond a system or a solution, and potentially look into B2B networks as an example. At Bottomline, we have one of the largest B2B networks in the world. It's called PayModeX, where we facilitate we facilitate all of the supplier payments within the network with security. It reduces a lot of the burden on companies on managing accounts payable and payments through the platform. Then the flip side of accounts payable is always accounts receivable, right? So how are you processing payments? How are you reconciling those payments? It's great that you got cash in the door, but if it takes you a while to close the books and reconcile, it's almost, you can't really use that cash until it's fully reconciled anyways. So, being able to have more automation on the accounts receivable side, where you're reducing DSO, so you can free up working capital, is great, but ultimately, the process needs to work automatically, right? Not manually. And last, AI and automation, right? We're moving way beyond. We used to talk a lot about robotic process automation. Now we're definitely moving a lot into AI, and things are just, technology's evolving quickly. Things are becoming easier. I mentioned some of the examples on leveraging AI for anomaly detection, leveraging AI to predict payment patterns, right? To know that your customers have different patterns that they'll pay you, and leverage AI in order to make those predictions, because it can be really difficult to keep track of what customers and how customers pay you and when. So just leveraging more AI within the solutions is really critical. So Craig, I'll pass it to you for any comments.
Yeah, I would just say that was a masterful job of going through that, and I felt it was very well covered, and also for where we are time wise, why don't we jump to our last two slides, and so that'll finish us up perfectly. You want to start us off on this one too?
Yeah, sure. So, first one, visibility, right? So what can you see today and when, right? So are you looking at real-time cash positions across all of your different subsidiaries, across the entire organization, or are you maybe, limiting yourself into how much visibility do you have? Is the data fragmented? All of that. Like, how can you consolidate and centralize all of the data? And then fraud, which is something I know we keep talking about it over and over again, is, what are the controls you have in your organization? Are you keeping pace with the evolution of these threats that are happening nowadays? Are the scams becoming more sophisticated in your organization? When was the last time that you actually, had a review of what your fraud prevention tools are? Going beyond just simple sanction screening, which is what most companies tend to stop, right? Are you looking beyond that into anomaly detection across payments in your organization or not? And I'll let you cover the other two, Craig.
Yeah. So on the liquidity side, a couple factors here. Like, think about time and what's involved in it. So my 0-day cash forecast is my cash position. Some organizations look at their short-term cash forecast as a week, some 13 weeks. Usually it caps out at about a year, so there's a significant range there. What about beyond that? When you get to 2, 3, or 4 years, you might be doing balance sheet forecasting. What does your balance sheet need to look like to support your business out farther? Very different from the close in, what are my needs in the next 13 weeks or so. But what are the, how is that changing? How is our business mix changing? How are we with regards to the practice of managing the cash conversion cycle, our working capital? Are we doing that effectively? Is too much being tied up due to a shifting business model or other activities? So liquidity requires a mature look at those different areas. Then over to technology is the question: is our technology of different generations? Technology shifts, and we see different shifts in technology, different levels, and we may not understand if it's just hosted in the cloud versus our desktop, or what version it is, or what level it is. But making sure we're staying with the newest or the next newest generation of technology matters. Why does it matter? It develops more fast, more quickly. It has greater capabilities. It allows us to interact maybe in a more natural language way, as opposed to coding. But when we think about the technology, what is most behind? What are we not doing that needs to be automated? What are we doing that's really old, that's not being supported? There's quite a bit that we can talk about here. But the last thing I wanted to mention is, what do we need to do with the data? And so if we look at data, I have to connect to it. It has to be in the right format. I need to use it for processes. I want to use it to do analysis. And so that has to be understood comprehensively in terms of the business process, the business life cycle, and the overall objectives of the organization. So those are a few things to throw out on the tech front. And that brings us to final thoughts. And by coin flip decided ahead of time, Leo will take the first two, I'll take the next two.
Perfect. Yeah. So, first one is just reassess your liquidity playbook, right? Is the days of just having static forecasts that get updated, once every couple weeks are over, right? So with the volatility today, your modeling needs to be continuous and needs to be based. It's really, that. And of course, connecting into how well is the treasury team integrated into the payments workflows in your organization. It's very basic things, but unfortunately are overlooked or are just the way companies operate nowadays because they're still very siloed. Next one is, for continue to stress test your exposures. So both FX and interest rate shocks, they can erode margins pretty quickly. So, you're still going back to forecasting and modeling, right? You need to be able to understand where a company's going. Don't look at FX as just a checkbox that you're matching what your board's policies say that you should do. Leverage more options. Leverage other financial instruments. But you can't do that on a manual basis.
The one extra thing on technology that I would add from the prior slide that I spoke on is, get technology that is current, modern, and can scale with your organization. That doesn't put you into a corner, paint you into a corner right from the beginning. And then finally, Leo said a bunch of good things about this in the beginning, about Treasury's strategic role. How are you supporting the organization from a risk, liquidity standpoint? And I won't just say from being an adult in the room, but making sure that those things are factored in all the business decisions and the business operations. Those matter significantly. And we really appreciate you taking the time to talk through these. So from Leo and I, from Bottomline and Strategic Treasury, we appreciate it. We'll turn it back over to Brian for a few quick comments at the end, and then there's a report as well.
Thank you, Leo. Thank you, Craig, and thank you everyone for joining us today. The CTP and FP&A credits, today's webinar slides, and a recording of today's webinar will be sent to you within 5 business days. And for more on this topic, be sure to download the Tariffs and Treasury Survey report by clicking the link in the chat box. Thank you, and we hope you have a good rest of the day.